That's a good way to look at inflation, I think, is this form of implicit default, basically, right?
That's right. It's just like a daily default.
Yeah.
Every single day.
Yeah.
Your dollar's worth less than it was the day before, period.
Right. And that's the taxpayer picking up the bill for government negligence.
I mean, so think about it. You've got, we know we operate in a deficit. We've talked about this before. We operate in a deficit and perpetually, and there's no way to get out of that deficit. Why? Well, I mean, if you look at numbers and where we are today, the Congressional Budget Office puts out data periodically. They had a report last May. They just came out with a report a few weeks ago, and it updates where they see the treasury and the balance sheet and the income statement. Well, we both know, like you just said, the treasury doesn't really make any income. Right. They collect ours through taxes. It's tax revenue. That's it. But in this report, which is super rosy, I mean, it is optimistic, and it's even a little bit old. Well, they project the treasury to they're going to take in about $4.8 trillion in taxes this year, tax revenue, tax collection, and but you basically have three main items in that make up the things that you have to spend money on, the expenses of the United States government, right? Three main items, and then you've got your revenue. All right, you got $4.8 trillion of revenue. Well, your entitlements are $3.8 trillion. Okay, so that's Social Security, Medicaid, Medicare, and some other programs adds up to $3.8 trillion a year. Okay, you have your defense spending. Well, but first those entitlements, those are signed into legislation. They have to be paid, right? That's mandatory expense.
Right.
Then you've got your long-term defense contracts, and those have to be paid. You can't default on payments with Boeing or Lockheed. You have to be paying those.
Right.
So, and that's about, they are estimating $700 billion this year in 2023, which we know is probably pretty low, especially since they're stuffing expenses for Ukraine and other places probably.
Right.
We just don't know exactly what those are.
Right.
So, so then you're now at 4.5 trillion, right? So you've got $300 billion left for your interest expense. However, they're expecting interest expense to be at $800 billion, right? And I think I actually transpose those numbers. Defense, they're expecting to be 700, to be 800, and interest is going to be 700. But the point is, you're now at $5.3 trillion of expenses on $4.8 trillion of revenue. So we're $500 billion in the hole. Well, what do? You have three choices. You can have austerity, which is cutting back programs, cutting back spending. It's political suicide. Neither party wants to do that, but they want to try to push the other party to do it. Right? Which we're seeing right now with the whole debt crisis, the debt ceiling crisis. So you can do that. You can raise taxes. And well, taxes are pretty high already. And when you do raise taxes, eventually it just slows productivity and it winds up having the same effect. It doesn't help. Or the third thing you could do is just issue more debt. Simple as that. Just issue more debt. So what we do is, as this debt matures, we issue more debt to pay off the principal of the people who own that debt, right? So, but the problem is we're operating in this perpetual deficit. So when you issue more debt and you're paying off that old debt, then that old debt was issued at very low interest rates, anywhere from just a few basis points up to maybe 1.5%, 1.75%, right? So this old debt that we're retiring, that matures, is now being replaced with debt that's about anywhere from 3.5% to 5% yield. So you see the problem, right? So mathematically, we have hundreds of billions of dollars more in expenses every year for new interest that we weren't paying last year. So the interest payments are going higher. More debt at higher interest rates equals, this is what we call the debt spiral, because you can't get out of it. You have to keep issuing more debt, issuing more debt, issuing more debt at higher interest rates, which just, this is the debt spiral. That's it. And we will never get out of this.
And to be clear, the $500 billion that we're printing to cover that interest expense, or borrowing rather.
Borrowing,
being printed by the Federal Reserve, right?
Well, not today. What happens is we sell that debt to private holders, banks or other sovereigns, or and so we have this luxury in the United States of being the global reserve asset, right? The treasury. And so everybody needs dollars, everybody needs treasuries to protect themselves, because it's known as the reserve asset, right? So we can keep issuing debt. So here's where we're at. We can keep doing that until there's a collapse in confidence in the US dollar. Right. So, which is what you and I were talking about just before the show, is that when does it all happen? When does it all collapse? Well, this can go on for a very long time. The US dollar is going to be the last one standing. It will swallow other currencies along the way in Brent Johnson's milkshake theory from Santiago Capital. Right. But what will happen is eventually the confidence in the dollar wavers. Why? Well, we have so much debt and our inflation is so high that people realize that if they own this treasury, that in 10 years, it's only going to be worth a fraction of what they bought it for, even with the interest rate. Why? Because real rates of return are negative. Because if your inflation is higher than the interest rate on that bond, then it's a negative real yield. So you're getting back dollars that are worth less, right? Then you can buy fewer or less of the goods and services that you could otherwise. The day that you bought those bonds. And so that's where we're at. The Fed is trying to make sure that we keep our interest rate, our CPI, the inflation rate down, at least in perception. They want people to perceive that inflation is under control. It's in check, because they can't have the buyers of our bonds lose confidence in the currency, and you lose confidence in the currency when it inflates too much because of what I just talked about, right? So they play with the numbers, they adjust the CPI, they adjust the way that they put things in and take and replace things in and out of the basket. Back in the 80s and before that, they used it was just a basket of goods, right? And it's just they used the same basket, and every single year they just priced that basket. And so you could see exactly what the inflation rate was. But they changed that to like an equivalent living index, right? So now what they can do is they can take goods in and out of the basket depending on how much they're inflating or how much people are using them. Well, there's elasticity, right? So if steaks are inflating, if they're getting too expensive, well, you might turn to ground beef instead, which is not inflating nearly as much. Well, so what the Bureau of Labor Services will do is they'll say, well, people are turning to ground beef in our surveys, so we're going to take steak out and put ground beef in. Well, what does that do? I mean, it's like survivorship. It's skewed to the survivorship of the goods, right? So, well, that one's too expensive, so take it out. Now your inflation rate comes down a little bit because of it. I mean, they do this. They play all kinds of games. The timing of when they track the goods goes from they just change it from 2 years to 1 year, so they can take things in and out of the basket every year now instead of every two. It's just
this is like earnings management on Wall Street, right? You're just tweaking the accounting classification so you can get to the number you want, so you can hit your EPS bonus target. Exactly. It's in the hypocrisy of it, right? It's if the CPI, which is intended to be a metric for price changes that are most relevant to most people, the things that actually change in price, they strip out. I mean, it's just totally...
It's nonsense.